Hello, hello. It's Daphne Jones, the Smart Money Chick, and it's great to be back with you on Money Monday. Hey, it's great to see you out there. Say hello. Let me know you're out there. It's great to be back up on my channels. The weather's holding steady down here in Texas. Just waiting, it'll change. We went from polar vortex to about 80 degrees in a matter of 2 days. So that's what happens with weather down here. It's awesome. It's awesome. It's great living in Texas. It's great living in the great US of A, America. It's pretty awesome. Hey, it's great to be with you tonight. And before I get into my subject about Bitcoin and life insurance, I wanted to give folks a few minutes to pull in here, to get in here tonight. A chance for us to talk, spend a little time. Unless you've been living under a rock, I'm sure you've heard quite a bit about Bitcoin. So just going to give my 2 cents on it. So we'll go on and we'll get started. So you all know my primary business is teaching financial literacy. You need to know what to do with your money in order to get your money to work for you. And your money does need a job. It shouldn't just be lying fallow. Once you pay your bills, and that's another subject about paying bills and what bills you should have. But once you take care of the basics, food, housing, clothing, any money left over needs to be put to work. It needs to have a job. Just shouldn't be lying fallow in the bank. You can determine the amount that you want to keep on hand for incidentals, car repairs, things like that, spending cash. But every dollar should have a job, whether it is to pay a bill, to be spending cash, or to grow, to multiply itself. And one of the things that I've been looking into, and I'm actually taking a part in, is Bitcoin. Is digital currency, or cryptocurrency rather, not simply digital currency. And you learn about what you invest in. So I've been spending a lot of time on Clubhouse. I've opened an account. I currently use Cash App. You'll see a link down in the description. You can go there and start investing in crypto, particularly Bitcoin. That's the only one that's sold there. Again, I'm not an advisor, but it's a very easy way to get started. You can do one-off purchases, purchase when you want to. You can set up repeating buys weekly, bi-weekly, monthly. But that's not the subject of tonight. Tonight is life insurance over Bitcoin. So you'll hear from enthusiasts about Bitcoin, those that either started early or recently started. You're watching how it has performed, particularly in the last 6 months. That has been a very good investment. Now, one of the things that you have to watch about investments is the exuberance when they're performing well, that they're the end all be all. So that has to be watched out with any investment, whether it be stocks themselves, ETFs, buying physical precious metals like gold or silver, that you get caught up in the hype and you start to overbuy. That's how you get bubbles. But I have my reasons to think that particularly crypto, and then in particular the types of crypto, because Bitcoin is like a brand of cryptocurrency. What's going to make them popular and what's going to have them sticking around? One, there is a limit to the amount of Bitcoin that it's ever going to exist. It's going to be limited to 21 million Bitcoins. Currently, there's a little over 18 million have been mined, and it's going to be several years in the future. I think the last number I heard, it's going to be at least 100 years into the future before the last Bitcoin is mined. But with the set amount, they're going to be a way to maintain value. That's why you see some major firms going into them. Elon Musk is an example. There are others, because the government is printing so much money. The various governments are printing so much money. It's not just the U.S. Governments print money to get out of debt. And that makes your money cheaper. It buys less because you have more money chasing fewer goods. The technical term for that is inflation. So crypto is looking at as a store of value, more so than what we call fiat currency, which is your physical dollar. But I'm saying all that to say, this is a fiat world. Fiat is the dollar is a means of exchange. Dollars is how you buy your gas. Dollars is how you pay your mortgage. Dollars is how you pay for your vacations. So at this point in time, Bitcoin isn't able to do that as easily. It's not as liquid as a dollar is. You can't just walk into any store, and pay with Bitcoin. Are certain things coming about? There are certain cards that you'll see advertised that can turn your Bitcoin into currency to spend, but it's not as liquid. So let's talk about what life insurance, the basic design of life insurance, and what it's meant to do. It is meant to provide a death benefit at your death. It's meant to take care of those that you're going to leave behind. So, think of your children, your spouse. You guys have set up a household. When an income earner, when a wage earner dies, that's not only the mental prop, you've got the loss of a loved one, and that is compounded by the loss of their income. This is how mortgages are paid. People plan on the incomes that are in the house, whether it's one or whether it's two. So when that income is lost, it needs to be replaced or supplemented immediately. That's something that a life insurance benefit does. Life insurances are paid very quickly. You can see a check within 24 hours. The death benefit coming to the family. That's not going to happen with Bitcoin. So, and it's designed to pay out at this particular time, and there's a guaranteed value that you're going to receive when the policy pays out. That, again, is different from Bitcoin. Bitcoin is an investment. And so the difference between an investment and a savings plan or a safe money vehicle like life insurance is that life insurance is not an investment. It's an insurance, it's a contract. They're saying that upon payment of these premiums, and that when certain things occur, like in this case, your death or the death of someone, X amount of dollars are going to be paid out to an assigned beneficiary. So that's not the case with Bitcoin. Now, again, as I said, to be transparent, I do own Bitcoin. And I do see Bitcoin as a way to create generational wealth and to pass it forward. Because, one, it doesn't have inflationary pressures, and it's transferable, and it is transferable. But when we're talking about the immediate aftermath of the death of a wage earner, Bitcoin is not liquid, and is not as immediately useful as the death benefit from a life insurance policy. So I know this isn't your normal happy thing that folks like to talk about normally in videos, whether we either like to get very angry or tell you that I know a way you can make millions of dollars very quickly. But we're all going to die, and we don't know when. Nobody plans on it. Nobody plans on dying. Not when it happens. No one plans on it. No one knows when this is going to happen. And so there has to be something there that cares for the people that you're going to leave behind. That's what life insurance does. And it does so immediately, which will be very different from what Bitcoin could do for you. So That's the main thing. It's the liquidity and the immediacy. And in the event of a death of a loved one, that's what you want. You want immediacy. There are things that has to be taken care of. Houses have to be shut down. Bills must be paid. Funeral arrangements must be made. The family still has to continue to live. Utility bills, food, things of this nature. That's what a life insurance death benefit does. It takes care of that. You put forth time to feed your kids, to dress them, to drive them places, to make sure they're educated. Those things are not going to end simply because you're no longer here, because you've died. That still needs to go on for the family. So by all means, get life insurance. Bitcoin as a part of your portfolio, sure. Make it a part of your portfolio. But that it be the be all end all, no. Bitcoin should not be your financial foundation. Life insurance should be. It should be the cornerstone of your planning, among other things. Which we talk about on the channel. We talk about real estate. We talk about owning businesses. We're going to have a serial entrepreneur next week, Sasha Walker. She owns several businesses, has started several businesses. So there are multiple ways to produce streams of income. But there's one way to protect income for those that you'll leave behind, and that is life insurance. Also, life insurance, because it is a savings vehicle, it can be calculated into future income. It's again, because it's a contract, not an investment. It's a savings vehicle. It can be used as future income. And in response also to Bitcoin is taxable. So when you purchase a Bitcoin and at a certain price, and then you may sell the Bitcoin, it's called taking your gains. Those things are taxable. And depending on how long you held the Bitcoin, depends if it's going to be capital gains or if it's going to be taxed a different way at a higher rate. That's not the case with money from life insurance policies. Whether it be your heirs receiving your death benefit or you taking cash out of your life insurance policy. So it's not taxable. That's the money you put in, the interest that it earned, even if and you have the type of life insurance policy such as a whole life insurance policy that also pays dividends from the life insurance company, that income that's produced is not taxable, regardless of when you take it out. It's so it doesn't matter how long you hold the policy, whether you hold it several years, it doesn't matter. As long as the cash is accrued, it's available for you to use. That's why you'll hear terms like the family bank, infinite banking, and things like that. It's individuals using their life insurance policies instead of going to a bank or on the open market to borrow money to do things with. Here, I'll give you an example of infinite banking. Okay, you have a traditional whole life insurance policy. Life insurance, the premium that you pay into a life insurance policy, it serves three things. One, it pays for the life insurance itself to keep the death benefit. A portion goes to the costs of the insurance company doing the work. That's a minuscule cost. And the third of it goes into an account that gains interest. So we'll just talk about traditional whole life insurance. We're not going to discuss universal or variable life insurance, about how interest is paid on those accounts. This is assigned interest that comes from the insurance company on a traditional life insurance. So also the other monies that go, you're getting paid that interest, and then regularly the insurance company pays dividends into the cash account. So this is how cash accrues. So the more money that you put in over the cost of insurance is what we call it, the larger the account grows. And the awesome thing is that in this case, you have compound interest working for you. Not against you like with credit cards, but working for you. So you're paid interest on top of the savings that you've already put in, the actual hard dollars you've put in. You earn interest on top of the dividends, and you earn interest on top of the interest. So it starts to compound. So each year the account is growing. And then it'll even reach a point, again, depending on how you're funding the account, it even starts to, in a sense, to hyper compound. So in the concept of family banking, instead of, let's say, you get to a point where, hey, I want to buy some capital goods. I want to buy some earth moving equipment, or I want to purchase vending machines. I want to start a business. So you figure your startup cost, CapEx, is going to run you $50,000. So instead of either you've saved up this $50,000, so you take it out of your life insurance. Now remember, this money, it's not like, say, if you sold X amount of Bitcoin to get $50,000, because at that point, that money is subject to tax because you've taken your gain, because it's an investment. Life insurance isn't like that. This is your money. You've borrowed it from yourself. Now, do you have to repay yourself? You should repay yourself, because this is how the family bank works. You pay back the money that you took out of your life insurance policy, and you pay it back at market rates. Now, borrowing from yourself, let's say market rates are at, and depending on your credit rating, let's keep it easy. Let's keep it at 10%. But you could borrow from yourself much lower, 2 to 3%. So Daphne, why would I pay an extra 8 points in interest when I don't have to? Because you're paying yourself. Remember, all monies that go into this life insurance policy, beyond the cost of keeping the policy active, earns you money. You're increasing your money. It's not like when you buy a car and they charge you interest and you're paying Ford Motor Credit. You're paying yourself this interest. That is compounding. Remember that magic word we talked about? It's compounding. So you've got this growth. And even though you used money that was your money to purchase the equipment, you're still going to get the tax write-off and things that you would normally get with the purchase of capital equipment. That's the beauty of infinite banking, of being the family bank, of being your own banker. So, well, Daphne, there has to be some catch. Well, the catch is that you have to actually save the money, that you have to actually open the policy, and then you have to fund it properly. Excuse me, let me turn this down. So, just let me answer this person. Yes. I could have sworn I said I'm on YouTube. So the idea is that you're paying yourself back, and you want to do this so that you can continue to borrow from yourself in the future. And again, the money coming from this insurance policy can be used for whatever you want it to. There's no restrictions like retirement funds, like 401ks or 403bs if you're a public service worker or anything of that nature. Not like SEPs if you own a business, anything like that. This money has no restrictions. The key is just to build up the account. So you're asking, what's the drawback? The drawback is the first few years that you're building the cash within the policy, because you have to physically put the money away. So that means the money is not being used for other things, whether it be to purchase Bitcoin, stocks, take trips with. It's a very aggressive savings plan. And that's the correct word to use. It's an aggressive savings plan. But it pays off in the end. So I guess it's you have to look at it as saying that, well, you're telling me that I'd have to do something 5 to 7 years. Well, that's going to take too long for me to get paid off. It's It's going to take too long for me to see money. But individuals will work 30 to 40 years for someone else to retire to pay taxes on that money. Because even if you put the money away post-tax, they're going to tax you when it comes out. And let's say, well, what about if I choose a Roth where I pay taxes and when the money goes in, the money grows tax deferred, and I take it out with no taxes? Okay. Life insurance still outperforms it. One, because it's a contract. You're not going to lose any money with a traditional life insurance policy, whole life. Remember, we're not talking about universal or variable life insurance. And you get a guaranteed death benefit, which is, again, very important because it protects you and it protects your income and it protects your family. You're not getting that when we're looking at Bitcoin or other investments, because that's the big difference. That's the major difference between life insurance and investments. Life insurance is not an investment. You may have heard individuals talk about it that way. It's not an investment. Investments built into the very possibility is loss. It's an investment. Yes, you're going to hope for returns and you hope for large returns, but there's a possibility of loss. That doesn't happen with traditional whole life insurance. There's guaranteed interest rates. There's dividend payments. There's guaranteed of a death benefit at the end. And the death benefit is pretty important. And then there are various types of life insurance. I'm talking about particularly whole life insurance, which is designed that if you continue to pay the premium, they're designed to last your entire life. This is in comparison to term life insurance, which has a set time period, just as it says. It's term life insurance. It can last anywhere 10, 15, 20 years. They're even 30-year policies. These policies are designed they're life insurance policies, but they tend to be cheaper than, say, permanent life insurance policies because they don't accrue a cash value. They do guarantee the death benefit, but they don't accrue cash value. And so they tend to be less expensive. They're a great way to get insured quickly. And if you wish to have a certain amount of insurance, you want to have a certain amount of insurance for a given amount of time. Say for the life of your mortgage, you want to make sure that the mortgage is paid off in the event of your death. And you want to do this for the least amount of money possible. So that's why you hear things like that a 35-year-old man can get $500,000 worth of insurance for $25 a month. Things of that nature. So not quoting that, but you've seen the commercials. So, hey, Michael, it's great. It's great to have you here. So that's that's why you get an insurance professional. It'd be great to talk to you about it. You can use the link below. We can meet via Zoom. And in those 15, 20 minutes, we'll talk about what your plans are, what you want to take care of, what's important to you, and how we can make insurance the cornerstone of what's going on with you financially, of how to protect what you're doing if you're just getting started. Yes, during COVID, still writing insurance policies. Insurance, it's easy to get. It's easy to get. Everything can be done online. Many carriers don't even require physicals at this time. So, and there's various types of insurance out there. A great way, instead of me just going on and on about what is available, I've also got a guide that's available. You see the link below. Hit the link that says guide at the end, and you can download an ebook, and it talks about life insurance, particularly after the age of 40. But it's applicable to those that are younger. And it talks about, well, it just gives you, it's a basic primer on life insurance. You can give it a read, and then again, and afterwards, you can set an appointment. We can talk and discuss about how you want to protect your family and protect yourself. And once again, I'm not anti-Bitcoin. I own some myself. It just doesn't replace life insurance. It has they're two different things. Both of them, quite frankly, both of them should be involved in the financial house you're building. Investments are important, but life insurance is essential. And so to get started, I'd take life insurance first. Again, we can structure policies that fit within a budget. We'll talk about what you want to achieve. That'll give you an idea of the budget that you're looking at for life insurance. Life insurance just does not have to be expensive. It is not expensive. It doesn't have to be. So, well, what are some of the things about life insurance that I'd be looking at? Well, one, the sooner the better. The sooner the better. I recommend insuring your children, actually. And I'll go into that. Do I suggest introducing your kids to Bitcoin and investing? Sure, I suggest. The earlier we become financially savvy, the better. That's very important in our community. And I think that's one of the things that we've lacked is discussing money with our children. And not just we don't have any or we don't want to spend it, but to discuss how to grow it and how to pass it on generationally. Yes, Michael, it is. I agree with that, about it being the foundations for the walls and other investments. It is. So one of the things that I often talk about is life insurance for kids. And it does several things for kids. One of them is it provides insurability. You can insure children as soon as they're born. So it gets them life insurance in case life happens, not just simply their death, which very sad to talk about, but children do die. But also they become ill and could become uninsurable, particularly, say, infant diabetes. Children do develop cancer and things of this nature. But they can have insurance already because you insured them early. Also, because insurance is a safe money vehicle, it's an excellent way to save money for college for kids. I think it's far superior to the 529 plan. And again, it's because of its tax-deferred nature. Tax-deferred nature. That we'll keep it that way. Because the money grows within the policy. Remember, I told you, money that accrues within an insurance policy is not taxable when you take it out, for whatever reason you take it out. That is not the case with 529 programs. One, with a traditional life insurance policy, you're guaranteed the interest and the dividends in the policy. That's not the case with a 529 plan. With a 529 plan, there's some underlying investment. So again, you have the risk of loss because it's an investment. The government provides you a tax break for the money that you put within the 529 plan. Okay, but they're going to tax you when you take the money out. They're not going to tax the growth of the money. Same thing with life insurance. But they're going to tax you when you take the money out to use it for your kid's college. And here's the kicker. You must use it for the kid's college. If the kid decides he doesn't want to go, he wants to open a taco truck, a lawnmower business, can't do that. Well, he can, but you're going to pay taxes that you didn't pay on the money, and you're going to pay a penalty to the IRS. Whereas the same funding that you put into the 529 program could have gone into a life insurance policy for the kid, and at the age of 18, money would have been available to do what the kid wanted to do, whether it was to go to school, buy a duplex, some cash flowing real estate, taco truck, lawnmower business. Didn't just have to go to college with it. It's freedom to use your money that you put away for your kid to do what you want to do with it. So that's a major advantage over a 529 plan. It's savings for your kid. It's not simply college savings. It's savings for your kid. And even if money's taken out at this time, let's say the money comes out when the kid's 19, 20 years old, the policy is still in effect. Because you can go back to, remember we talked about the family bank. This policy will work the same way. The money can be paid back into the policy. And so this death benefit is increasing. The savings within the policy is increasing. And say 40 years later, the kid can take money from the account to use as a retirement plan. That's where you often hear about tax-free retirement, the miracle plan, tax-free retirement. It's funding with life insurance policies because once again, money taken from a life insurance policy is tax-free. You pay taxes one time when you put the money on the money you earned to go into the policy. Policy gains interest, dividends. And this money, now if you use it for retirement purposes, it's not like a family bank. You never pay that money back. But those policies are designed to pay well past the age of 100. The actuaries, the way they're designed and when you pay into them. So you have this given tax-free income until death. And still, because it's a life insurance policy, you still getting a little thirsty. There's still a death benefit for your heirs. Oh, thanks. Excuse me. So there's still a death benefit for your heirs. So there's a multiple things. It's a very useful tool, life insurance. That's why I feel very confident in saying that it's foundational to your financial planning. Again, you say, I want to go into real estate at some point, cash flowing real estate. I want to start a business. I want some investment vehicles. I want to purchase crypto. All that is excellent. All that should be a part of what you're going to do financially, because your money should work for you. It should create other dollars. It should multiply. But life insurance is the underpinning for that, because it does multiple jobs, and it's at a great tax advantage. So, if you've got any questions out there, it's been great talking to you all. We've hit a little over 30 minutes, 33 minutes. I think I hit my big points. Love to see you next week. We're coming up with a new time. We're going to be going on at 6:30 Central instead of 7:30. Yeah, I think it'd be a good time, 6:30. So you can follow me on my various social platforms. Of course, I'm here on YouTube, Smart Money TV. I'm on Facebook at The Smart Money Chick, Instagram, The Smart Money Chick, and I'm also on Twitter, Smart Money Hotel. So it'd be great to see you there. On Clubhouse also as The Smart Money Chick. Again, looking to hear from you. Be great to hear from you. I'd love to know what you're doing, how things are going with crypto, insurance questions. Again, links below. You can download my guide, or we can also meet. The link's there. The link says life insurance book. Again, love to hear from you. Again, I want you guys to stay safe out there. Take good care of yourself. And as always, God bless America. You guys have a great evening. Bye-bye.